What if I told you that the stock market's wild swings, from massive gains to devastating crashes, have been repeating the same pattern for centuries? That's right, the wild ride we see today isn't new at all. From the madness of Tulip Mania in the 1600s to the dot-com boom and bust, history is full of stories where people chased quick riches only to see their dreams crash. Why do we keep falling for these financial traps? Today, we're diving into some of the biggest market booms, and we will also uncover the reasons behind this madness. But why do these bubbles keep happening, and what can we learn from them? In this video, we will answer those questions along with the evolution of how things came to be. By the end, you'll understand why the stock market's highs and lows continue to captivate us, and why they're never really gone for good. So what is the Tulip Mania? Well, Tulip Mania is often called the first big financial bubble in history. In the 1630s, the Dutch became obsessed with tulips, especially rare and exotic ones. These flowers, which started as a luxury item for the rich, quickly became a status symbol. Everyone wanted a piece of the action, and soon, people were trading tulip bulbs like they were gold. Prices skyrocketed, and some tulip bulbs were worth as much as a house. But like all bubbles, it didn't last. People started to realize that they were paying crazy amounts of money for just a flower. The market crashed almost overnight, and many who had invested everything in tulips lost it all. This event was a classic example of people getting caught up in the hype, thinking prices will keep going up forever, only to end up as a disaster. Then, in 1720, the South Sea bubble was another major financial disaster, this time involving the British government. The South Sea Company was a trading company with a monopoly on trade in the South Seas, which was an area around South America. But instead of focusing on trade, the company started selling shares of itself, promising huge profits. The hype around these shares grew, and everyone wanted in. The British government even got involved, thinking they could clear the national debt by backing the company. As more people invested, the share prices soared. But as with Tulip Mania, this bubble was built on nothing but speculation and false promises. The company wasn't making the profits it had promised, and when people started to realize this, the market crashed. Investors, including many in the government, lost huge sums of money, leading to public outrage. The South Sea bubble showed that even governments could get caught up in market mania, and when they do, the fallout can be devastating. The Roaring Twenties were a time of great economic growth and wild spending in the United States. People were making money in the stock market like never before, and everyone wanted a piece of the action. Stock prices kept going up, and it seemed like the good times would never end. People were borrowing money to buy stocks, thinking they could sell them at a profit and pay off their loans. But the stock market can't go up forever. And in October 1929, it all came crashing down. The stock market crash of 1929 was the most devastating in US history, wiping out millions of dollars in wealth almost overnight. Banks failed, businesses went bankrupt, and many people lost everything. The crash marked the beginning of the Great Depression, a period of severe economic hardship that lasted for years. The 1929 crash taught harsh lessons about the dangers of unregulated markets and excessive speculation. It became clear that something had to be done to prevent such a disaster from happening again. This led to the creation of modern market regulations, including the establishment of the Securities and Exchange Commission (SEC) in 1934. The SEC was designed to oversee the stock market and protect investors from fraud and excessive risk-taking. The crash of 1929 showed the world that the stock market is not just a game. When things go wrong, the effects can be felt across the entire economy. The dot-com bubble of the late 1990s was fueled by the rapid growth of the internet. The internet was a new and exciting technology that promised to change the world. Companies with .com in their names were popping up everywhere, and investors were eager to get in on the action. It seemed like every internet startup was destined for success, and people were throwing money at these companies, expecting huge returns. The problem was, many of these companies were all hype and no substance. They had big ideas but no real way to make money. Still, their stock prices soared as everyone wanted to invest in the next big thing. Some companies didn't even have a product, but that didn't stop investors from pouring money into them. Like all bubbles, this one eventually burst. By 2000, people started to realize that many of these companies were never going to be profitable. The stock market crashed and billions of dollars in value were wiped out almost overnight. Many internet companies went bankrupt and investors lost huge sums of money. The dot-com bubble was a hard lesson in the dangers of overvaluing new technologies. It showed that just because something is new and exciting doesn't mean it's a good investment. Investors learn to look beyond the hype and focus on whether a company has a solid business plan and a real chance of making money. Then came the 2008 financial crisis. It was one of the most devastating economic events in modern history. It started with the housing market in the United States. For years, housing prices had been going up, and people believed they would continue to rise. Banks were giving out mortgages to almost anyone, even people who couldn't really afford them. These risky loans were then bundled together and sold as safe investments to other financial institutions. As more people bought homes they couldn't afford, housing prices kept going up, creating a bubble. But like all bubbles, it eventually burst. When people started defaulting on their loans, the value of those bundled mortgages plummeted, and it led to huge losses for banks and investors. The crisis spread quickly, which caused a domino effect that hit the global economy. A lot of banks failed, people lost their homes, and millions lost their jobs. The crisis led to a deep recession that took years to recover from. Governments around the world had to step in to bail out banks and stabilize the economy. The crisis also led to new financial regulations aimed at preventing something like this from happening again. The 2008 financial crisis happened due to reckless lending and showed how interconnected the global economy is and how a problem in one area, like housing, can quickly spiral out of control and affect the entire world. So let's address the main question. Why do we keep seeing the same types of bubbles over and over again? It all comes down to human psychology. People are naturally drawn to the idea of getting rich quick, and when they see others making money, they want in on the action. This leads to a herd mentality, where everyone starts buying into the same idea or market, pushing prices higher and higher. Fear of missing out, or FOMO, plays a huge role in this. No one wants to be left behind when it seems like everyone else is getting rich. So, people start investing without fully understanding what they're getting into. As more and more people join in, the bubble grows. The problem is, bubbles are built on unrealistic expectations. People convince themselves that this time it's different, and that prices will keep going up forever. But deep down, we know this isn't true. Eventually, reality sets in, and the bubble bursts, leaving a lot of people with big losses. Even though history is full of these stories, we keep making the same mistakes. That's because it's hard to fight against our natural instincts. Greed, fear, and the desire to fit in are powerful forces that drive our behavior. Understanding these psychological factors can help us recognize bubbles before they get out of hand, but it's easier said than done. So, what can we learn from all these bubbles? First, history shows that markets can be unpredictable and risky. Just because something is popular doesn't mean it's a safe bet. It's important to do your research and not get swept up in the hype. Bubbles form when people ignore the fundamentals and chase after quick profits. Staying grounded and making decisions based on solid information is key to avoiding the pitfalls of market bubbles. Looking ahead, it's likely that we'll see more bubbles in the future. New technologies, trends, and opportunities will always tempt investors to jump in. But with the lessons we've learned from past bubbles, we can hopefully recognize the signs earlier and avoid the worst of the fallout. If you enjoyed learning about the history of market bubbles, don't forget to like and subscribe. There's plenty more to explore, and we'll be diving into even more fascinating topics in our future videos. Thanks for watching, and we will see you in the next one.